No, now we're seeing gigantic bets. You know, the sort that you see when people really are truly nervous, Brian. So, for instance, ProShares has a triple leverage short contract on the S&P 500. And as you might imagine, since the S&P 500 is up 15 or more percent, or was prior to today for the year, people that have bought that triple levered ETF have failed mightily all year long. It's just been going from upper left to lower right. But now we see yesterday big bets coming in. Let's see, what was it? The July 17 calls. So these expire next Friday, Brian. Not this coming Friday, tomorrow, but next Friday. And they were buying a ton of these upside calls. How many of them did they buy? 40,000. I mean, they bought a ton of these upside calls. Those calls, since it's an inverse, they make money if the S&P falls, and it's a triple levered call. So this is a very big either hedge, Brian, or as I said before, a bet that markets sort of melt a little bit into next week.
That would seem to be, correct me if I'm wrong, John, and I frequently am, that would seem to be too big of a bet to be a straight up hedge.
Yeah, and most people that are going to do a hedge don't do a leveraged hedge. They don't do a 2-to-1 or a 3-to-1 like this one. The symbol on it is SPXU. And so, again, it is just an ETF, a triple levered ETF. They get most of that leverage side from a swap contract that they do. But to somebody who buys it, and they bought right at the money, they bought that at 17. So they're basically saying, you know, if the S&P falls as it is today by 1% or more, well, this is going to move about 3% on that day. And that's exactly what's playing out so far today.
Listen, it's 5:54 in the morning, 4:44 in Chicago, 4:54 in Chicago. That'd be funny if it was an hour and 10 minutes behind. And so I want to clarify exactly what you just said. For some people waking up, getting their coffee, hearing a bunch of this stuff, there appears to be, based on that trade, it's got to be a gigantic market player who appears to be making a pretty gigantic bet against the stock market in the short term. Fair to say?
Yes, very fair to say, and very accurate. And like we both discussed, sometimes these bets or hedges get expressed through the VIX contract. And one of those big players in there is known as 50 Cent because he tends to buy 50 cent priced options that are way out of the money, knowing that if we did see a meltdown, that those options would pick up in value pretty dramatically and hopefully offset either the portfolio losses or, just as we both discussed, a straight out bet short term that, hey, I think in the short term we might see a snap to the down.